Welcome to IRAS's seminar on the Overseas Vendor Registration or OVR regime for goods and services tax. This seminar explains the extension of the OVR rules and highlights the areas OVR vendors need to do in order to comply. For this seminar, we will be going through these segments. You may find timestamps to the various segments in the video description below. First, we will start with a brief recap of the OVR regime. Next, we will look at the scope of the extended OVR regime, followed by the GST registration threshold of OVR vendors, which will explain when OVR vendors need to register for GST with Singapore Tax Authority, IRAS. We will then explain features of the simplified pay-only regime that most overseas suppliers will be registered under, and the implications of this extension of the OVR regime to existing and new OVR vendors. Subsequently, we will share more on the prevention of double taxation on importation of LVG and the exceptions that are available to OVR vendors. Lastly, we will explain the time of supply and transitional rules and end the seminar by explaining how OVR vendors can prepare for the extension of the OVR regime. Firstly, a brief recap of the overseas vendor registration regime that is implemented from 1st January 2020. Any supplier belonging outside Singapore that has a global turnover exceeding $1 million and makes supplies of digital services exceeding 100,000 to non-GST registered customers, also known as business to consumer or B2C supplies, in Singapore, is required to register, charge, and account for GST. This meant that imports of digital services are subject to Goods and Services Tax, or GST, from 1st January 2020 under the OVR regime. However, not all imported services are subject to GST. Imported services that do not fall within the definition of digital services are not subject to GST. In addition, goods imported via air or post with value not exceeding $400 are not subject to GST as they are eligible for the GST import relief. As such, to ensure a level playing field for our local businesses to compete effectively, the OVR regime will be extended to tax these supplies. We will take a look at the scope of the extended OVR regime. From 1st January 2023, the overseas vendor registration regime will be extended to tax supplies of non-digital services as well as imported low-value goods or LVG in short to non-GST registered customers. Digital services which are currently subject to GST will remain taxable. Both digital and non-digital services will be known as remote services under the extended regime. We will cover the definition of remote services and LVG in the subsequent slides. What are remote services? Remote services are defined as any services where, at the time of the performance of the service, there is no necessary connection between the physical location of the recipient and the place of physical performance. Some examples of remote services are supply of digital products such as mobile applications and e-books, supply of professional services, and supply of personal services. Here are some examples of services that are excluded from the extended OVR regime. They are: number 1, exempt services that fall under the 4th schedule of the GST Act. Number 2, services that qualifies for zero rating under Section 21(3) of the GST Act had they been provided by a local supplier. Number 3, services provided by an overseas government that are of the nature described in the schedule of the GST Non-Taxable Government Supplies Order of the GST Act. And number 4, on-the-spot services that require the customer to be physically located at the place where the services are provided. For more examples of remote services under the extended overseas vendor registration regime, you may refer to Annex A in our e-tax guide on taxing remote services by way of the overseas vendor registration regime, available on our website. We have also included the link to the e-tax guide below in the video description. What are LVG? LVG is defined as goods which at the point of sale are not dutiable goods or are dutiable goods but payment of the customs duty or excise duty chargeable on the goods is waived under Section 11 of the Customs Act, are not exempt from GST, are located outside Singapore and are to be delivered to Singapore via air or post, and lastly, have a value not exceeding the GST import relief threshold of $400, hereinafter referred to as the entry value threshold. To determine if the goods fall within the definition of LVG, We look at the sales value of the goods to determine if the value of the goods fall within the entry value threshold of $400. Sales value refers to the selling price of the goods, which is the amount of consideration received or receivable for the supply, but excluding any amounts charged for transportation and insurance costs, any GST chargeable on the supply of LVG, and any duties payable to Singapore Customs. Please note that the sales value is for the determination of the entry value threshold and is different from the value of a supply of LVG on which GST is chargeable. The value of supply of an LVG would include amounts paid by the customer for related services, such as transportation and insurance, and GST is charged based on this value. When a customer who is not GST registered in Singapore purchases multiple goods from an OVR vendor, the OVR vendor may bundle and ship the goods in a single consignment or as individual consignments. Regardless of the way the goods are bundled for shipment, the goods should be disaggregated and valued separately as separate items, even if the combined value of the consignment were to be greater than the entry value threshold. In other words, the entry value threshold would apply individually to each items of goods supplied. However, there is an exception where OVR vendors may make an election to apply the entry value threshold on a per consignment basis as opposed to on individually goods supplied, if certain conditions are fulfilled. Further information on this exception will be shared later in the subsequent slides under the exceptions that are available to OVR vendors for the importation of LVG. Next, let us look at example 1, which provides more clarity on the usage of sales value to determine the entry value threshold and the value of supply on which GST is chargeable. In this example, a dress is listed for sale at $420 before GST, which includes a separate and explicit charge of transportation and insurance fees of $25. To determine whether the supply of the dress falls within the entry value threshold, and if it is an LVG, supplier A is required to exclude the transportation and insurance fees charged to the customer. Thus, the sales value of the dress would be $395 and it is a LVG. On the other hand, the value of supply of the dress is $420, which includes the transportation and insurance fees of $25. The GST will be 7% of this value of supply, which amounts to $29.40. Supplier A collects a total money consideration of $449.40 from the customer, being the summation of the value of supply and GST amount. Next, we'll look at who will be affected by the extended OVR regime. For local vendors, they are local suppliers, local electronic marketplace operators when the electronic marketplace is regarded as the supplier, and local redeliverers when the redeliverer is regarded as the supplier. For overseas vendors, they are overseas suppliers where the overseas supplier's belonging status is outside of Singapore, overseas electronic marketplace operators when the electronic marketplace is regarded as the supplier, and overseas redeliverers when the redeliverer is regarded as the supplier. Local suppliers making direct sales of LVG warehoused overseas to Singapore will now be affected by the extended OVR regime. Direct sales refers to goods that are supplied directly by local and overseas suppliers to customers who are not GST registered in Singapore, instead of supplying the goods through an electronic marketplace or redeliverer. Currently, the sales of LVG warehoused overseas by local suppliers to Singapore are treated as outside the scope of GST, since the goods are located outside Singapore at the time of supply. With the implementation of the extended OVR regime on LVG, they will now fall within the scope of GST. GST registered local suppliers would be required to charge and account for GST on the direct sales of LVG to customers who are not GST registered. Non-GST registered local suppliers who make direct sales of LVG to non-GST registered customers would be required to include such supplies in their taxable turnover to determine their GST registration liability. We will now look at when an electronic marketplace is regarded as the supplier. Electronic marketplace operators are regarded as a supplier of the imported LVG or remote services if any of the 5 prescribed conditions are met. The first condition is the marketplace authorizes a charge to the customer. This means that the marketplace communicates the liability to pay to the customer and influences whether or at what time the customer pays for the supply. Most marketplaces would be regarded as the supplier due to this first condition. For this condition to be met, it is not necessary for the electronic marketplace itself to collect or receive the payment or be involved in the entire payment process. For example, to authorize the charge, the electronic marketplace may only initiate the process by which the customer is charged, including situations where the electronic marketplace website connects the customer to a third party who processes the payment. The second condition is the marketplace authorizes the delivery of supplies to the customer. The marketplace may deliver the item itself or notify a third party to commence delivery on its behalf. The third condition is the marketplace sets the terms and conditions under which the supply is made. The marketplace may have influence over pricing, require specific payment of delivery methods, or provide the customer support or own customer data. The fourth condition is the documentation issued to the customer identifies the supply as made by the marketplace. These include receipts, invoices, or information displayed on the marketplace's website. The fifth condition is the marketplace and merchant contractually agree that the marketplace is responsible for GST obligations. Considering the conditions in totality, most electronic marketplaces would be regarded as the supplier, except platforms that purely provide listing services. Next, we'll look at who are regarded as redeliverers. Redeliverers typically provide ship-for-me services or buy-for-me services to customers who wish to procure particular goods from overseas vendors that do not ship to Singapore. Under ship-for-me services, redeliverers assist customers to ship their purchases from overseas to Singapore by providing an overseas forwarding address. Customer instructs the supplier to deliver goods to this overseas forwarding address, and the redeliverer will arrange to ship the goods to Singapore. Under buy-for-me services, redeliverers assist to place orders of goods from the supplier on behalf of the customer and arrange for the shipment of the goods from overseas to Singapore. For such an arrangement, the supplier or electronic marketplace cannot be expected to account for GST on the supply, as they are unlikely to know that the goods are ultimately destined for importation into Singapore. Therefore, redeliverers would be in the better position to determine if the goods are to be imported into Singapore. Consequently, local and overseas redeliverers would be regarded as the suppliers for LVG supplied by local and overseas suppliers and electronic marketplaces, when certain conditions are met. Redeliverers are regarded as a supplier of the LVG if, firstly, no electronic marketplace operator is treated as the supplier of the goods. Secondly, the supplier of the goods does not deliver or arrange the delivery of the goods to Singapore. And, lastly, the redeliverer delivers or facilitates the delivery of the LVG to Singapore and does one or more of the following: provides or facilitates the use of an address outside of Singapore for delivery of the LVG, or purchases or facilitates the purchase of the LVG. We will now proceed to explain the GST registration threshold of overseas vendors under the extended OVR regime and explain when they need to register for GST. Firstly, for overseas vendors, they are liable for registration with effect from 1st January 2023 if they satisfy the conditions under either the retrospective or prospective basis. Under the retrospective basis, an overseas vendor is liable for GST registration if its global turnover and value of B2C supplies of LVG and remote services to Singapore for the calendar year, meaning 1st January to 31st December, exceed 1 million and 100,000 respectively. Under the prospective basis, an overseas vendor is liable for GST registration if it can reasonably expect the value of its global turnover and B2C supplies of LVG and remote services to Singapore will exceed 1 million and 100,000 respectively for the next 12 months. For an overseas electronic marketplace operator, if it is regarded as a supplier, it is required to include these three supplies in computing its global turnover and its value of LVG and remote services made to Singapore when determining its GST registration liability. They are, firstly, to include supplies of LVG made by local and overseas suppliers to non-GST registered customers via its marketplace. Secondly, to include remote services made by overseas suppliers through its marketplace to non-GST registered customers in Singapore. And lastly, to include its own supplies of LVG and remote services made directly to non-GST registered customers. When the overseas marketplace operator is GST registered, it will need to charge and account for GST on such supplies instead of the suppliers, regardless of whether these suppliers are GST registered or not. We will look at example 2 on how overseas electronic marketplace A determines its GST registration liability. Overseas electronic marketplace A operates an e-commerce platform which lists and sells its own brand products on behalf of local and overseas sellers. Its annual global turnover in 2023 is 3 million. For the year 2023, sales of LVG by the local and overseas suppliers through Marketplace A to non-GST registered customers amounted to 60,000. Marketplace A's own sales of LVG to non-GST registered customers amounted to $50,000. To determine its GST registration liability, Marketplace A must sum up the value of the LVG supplied by the local and overseas suppliers through its marketplace and its own supplies of LVG, with the total amounting to $110,000. As Marketplace A's global turnover and supplies to Singapore exceed 1 million and 100,000 respectively, it is liable for GST registration under the Overseas Vendor Registration regime. For an overseas supplier, it is important to note that supplies of LVG and remote services made by a supplier through an electronic marketplace operator that is regarded as a supplier are accounted for by the marketplace and disregarded for the purpose of assessing whether the supplier must register for GST. In example 3, the overseas supplier's 60,000 worth of LVG supplied through an overseas electronic marketplace operator that is regarded as the supplier is disregarded for the purpose of assessing whether it is liable to register for GST. For an overseas redeliverer, if it is regarded as a supplier, it is required to sum up the value of its own B2C LVG supplies made to non-GST registered customers, as well as the value of B2C LVG supplies made by local and overseas suppliers, for which it assisted non-GST registered customers to purchase and or deliver to Singapore, to determine its GST registration liability. When the overseas deliverer is GST registered, it will need to charge and account for GST on such supplies instead of the suppliers, regardless of whether these suppliers are GST registered or not. We will look at example 4 on how overseas redeliverer B determines its GST registration liability. Overseas company B is a redeliverer which assists customers to purchase and ship their purchases from overseas to Singapore by providing the use of an overseas forwarding address. For the year 2023, Company B assisted non-GST registered customers with the purchase and delivery of LVG to Singapore. The value of this LVG amounted to 1.2 million. As Company B's global turnover and supplies of LVG to Singapore exceed 1 million and 100,000 respectively, it is liable for GST registration under the Overseas Vendor Registration regime. Next, we will look at the dates overseas vendors need to notify IRAS by and the effective dates of GST registration under the retrospective and the prospective basis. Under the retrospective basis, if the registration liability is triggered on or after 31st December 2022, the OVR vendor will need to notify us within 30 days of the end of the calendar year, and its effective date of GST registration will be at the end of the month following the month in which the 30th day falls. For example, if the liability arises during the calendar year 31st December 2022, the overseas vendor is required to notify us by 30th January 2023, and they will be GST registered on 1st March 2023. Under the prospective basis, if the registration liability is triggered on or before 23rd September 2022, the overseas vendor is required to notify IRAS by 1st October 2022, and its effective date of GST registration will be 1st January 2023. If the registration liability is triggered from 24th September to 31st December 2022, the overseas vendor is required to notify IRAS by 31st January 2023, and its effective date of GST registration will be on 1st February 2023. If the registration liability is triggered on or after 1st January 2023, the overseas vendor is required to notify IRAS within 30 days from the date of the forecast, and its effective date of GST registration will be the 31st day from the date of the forecast. Example 5 illustrates the liability to register under the retrospective basis. Overseas business A's value of the B2C supplies of LVG and remote services to Singapore during the calendar year ended 31st December 2022 is 200,000, and its global turnover for the calendar year ended 31st December 2022 exceeds $1 million. It is liable to register for GST under the retrospective basis, as its global turnover and value of B2C supplies of LVG and remote services to Singapore for the calendar year exceed 1 million and 100,000 respectively. It is required to notify IRAS by 30th January 2023. However, for overseas business B, as it is certain that the value of B2C supplies of LVG and remote services to Singapore will not exceed 100,000 in the next calendar year, and it can substantiate this with documentation, overseas business B will not be liable for GST registration. Example 6 illustrates the liability to register under the prospective basis. Overseas business A can reasonably expect the value of its global turnover and B2C supplies of LVG and remote services to Singapore to exceed 1 million and 100,000 respectively for the next 12 months on 20th September 2022. As the registration liability is triggered on or before 23rd September 2022, it is required to notify IRAS by 1st October 2022. On the other hand, overseas business B can only reasonably expect the value of its global turnover and the B2C supplies of LVG and remote services to Singapore to exceed 1 million and 100,000 respectively for the next 12 months on 24th September 2022. The registration liability is triggered from 24th September to 31st December 2022, and it is required to notify IRAS by 31st January 2023. We will now proceed to explain the GST registration threshold for local vendors under the extended OVR regime and explain when they need to register for GST. GST registration for local vendors will follow the usual GST registration threshold. They must register for GST if their combined turnover is, under the retrospective view, more than 1 million at the end of the calendar year, or, under the prospective basis, expected to be more than 1 million in the next 12 months. Do note that the 100,000 registration threshold based on the value of B2C supplies of LVG and remote services to Singapore does not apply to local persons. For a local supplier who makes direct sales of LVG warehoused overseas to non-GST registered customers in Singapore, it is required to include the value of such direct sales of LVG and its own standard rated and zero rated supplies in computing its combined turnover to determine its GST registration liability. For a local electronic marketplace operator, if it is regarded as a supplier, it is required to include these four supplies in computing its combined turnover when determining its GST registration liability. They are to include supplies of LVG made by local and overseas suppliers to non-GST registered customers via its marketplace, to include remote services made by overseas suppliers through its marketplace to non-GST registered customers in Singapore, to include its own direct sales of LVG to non-GST registered customers in Singapore, and include its own standard rated and zero rated supplies. When the local marketplace operator is GST registered, it will need to charge and account for GST on such supplies instead of the suppliers, regardless of whether these suppliers are GST registered or not. For a local redeliverer, if it is regarded as the supplier, it is required to include these three supplies in computing its combined turnover when determining its GST registration liability. They are: number 1, to include supplies of LVG made by local and overseas suppliers to non-GST registered customers for which it assisted non-GST registered customers to purchase and/or deliver to Singapore. Number 2, to include its own direct sales of LVG to non-GST registered customers. And lastly, to include its own standard rated and zero rated supplies. When the local redeliverer is GST registered, it will need to charge and account for GST on such supplies instead of the suppliers, regardless of whether these suppliers are GST registered or not. We will now explain the features of the simplified pay-only regime that most overseas vendors will be registered under. Overseas vendors under the pay-only regime do not need to appoint a local agent to handle their tax matters. There is also no requirement to provide any security deposit unless the overseas vendor is registering on a voluntary basis. Overseas vendors under the pay-only regime will also file simplified returns with only certain relevant fields available. Simplified returns are filed on a quarterly basis with filing and payment due within 1 month from the end of the accounting period. It is important to note that input tax claims are not a feature under the simplified pay-only regime. If an overseas vendor is in a net refundable position, the net GST refundable will be retained as credit for offset against GST payable in future periods. Subject to controller's approval, overseas vendors may request for net GST to be refunded if they are willing to bear the associated remittance charges. If errors are made in the current GST return, overseas vendors are not required to complete the GST F7 return to correct the GST return that has been filed. Instead, a concession has been granted to allow them to correct any errors made in their next GST return. Where significant errors are made, overseas vendors may write in to request for an adjustment of their GST returns, providing reasons for the adjustment. We have also made bad debt relief available to overseas vendors. Bad debt relief is available upon completing the self-review checklist with the GST refundable held as credit. There are no additional invoicing and price display requirements imposed beyond the overseas vendors' usual business practices. The record-keeping rules are generally similar to the rules for domestic GST-registered businesses. Lastly, overseas vendors are required to maintain proper business and accounting records for at least 5 years and make available upon request supporting documents including sales listings, invoices issued, payment evidence, and customer information such as GST registration number to substantiate GST collected from all supplies made to customers in Singapore. Moving on, we will now explain the implications of this extension of the OVR regime on existing and new OVR vendors. For existing OVR vendors, they do not need to register for GST again. They can proceed to charge and account for GST on the supply of LVG and remote services from 1st January 2023. Both existing and new OVR vendors will, however, need to make changes to their accounting systems and business processes to identify whether there is a need to charge GST on their supply of LVG and remote services by determining, firstly, where the customers belong. Secondly, whether the goods are imported into Singapore. And lastly, whether the supplies are B2C supplies. For remote services, when determining where customers belong, the existing belonging status guidelines will apply. For corporate entities, we look at the business establishment and fixed establishment rules. For individuals, we look at their usual place of residence. However, we understand that information may not be readily available to overseas suppliers. They may instead maintain 2 pieces of non-conflicting evidence based on the following proxy categories. Number 1, the payment proxy. Number 2, the residence proxy. And lastly, the access proxy. The 2 evidence pieces should comprise 1 payment proxy and either a residence or access proxy. However, if the payment proxy is not available or is contradictory, the overseas supplier is required to obtain 2 pieces of non-conflicting evidence consisting of a residence and access proxy each. For example, in example 7, an Australian resident visiting Singapore purchases and downloads a movie digitally from overseas company D which is registered under the OVR regime. Customer's IP address indicates that he belongs in Singapore, but a customer's billing address indicates that he belongs in Australia, which matches the credit card information provided. Company D concludes that the customer belongs in Australia and does not charge GST on the sale of the movie. For LVG, they are regarded as imported into Singapore if the goods are delivered from outside Singapore to a recipient in Singapore. An OVR vendor may regard a supply of LVG as delivered from outside Singapore to a recipient in Singapore if the goods are located outside Singapore at the point of sale and the shipping address indicated by the customer shows a Singapore address and the goods are delivered to the Singapore address. Lastly, both existing and new OVR vendors will need to determine whether their supply is a B2C supply. B2C stands for business to consumer and refers to transactions made by GST registered person to a non-GST registered customer. By default, overseas vendors will treat their supplies as being supplied to non-GST registered customers and charge GST on their supplies. GST registered customers are responsible for providing their GST registration number to overseas vendors so that GST will not be charged. Overseas vendors will therefore have to make certain system changes to allow customers that are GST registered to provide their GST registration numbers so that GST will not be charged on their purchases. For situations where GST was incorrectly charged on supplies to GST registered customers, the customers would have to obtain the refund directly from the overseas vendors. Next, we understand that there may be a possibility where GST is collected twice on the LVG. We will look at how we can minimize such situations from happening and prevent double taxation on LVG. GST may be collected twice, first by the OVR vendors and again at Singapore Customs border under the following situations. We will go through each of these situations in the following slides. Firstly, multiple LVG shipped as a single consignment could result in the total CIF value to be above $400, which means that GST will be collected again at customs border since the CIF value is above $400. Secondly, for imported goods sold in a foreign currency, there could be exchange rate fluctuations arising from the differences in timing in the application of the exchange rates by the suppliers and by Singapore Customs. Goods that were under the value of $400 could exceed the threshold due to the timing differences in the application of the exchange rates, which result in GST being collected again at customs border. Lastly, OVR vendors are required to use the sales value of the goods to determine whether the goods are considered LVG, which excludes insurance and freight costs. However, customs value is determined based on the cost, insurance, and freight (CIF) value at the time of importation to determine whether the import exceeds the GST import relief threshold of $400. Thus, there could be instances where the OVR vendor charges GST on a supply of LVG as the sales value of the goods is below $400, and during importation, the CIF value of the goods exceeds $400, which results in GST being collected again at customs border. To address instances of double taxation, where the sales of goods are taxed as LVG at the point of sale by the OVR vendors, but are taxed again upon importation at the border, OVR vendors are required to include the relevant GST information in the commercial document, which is passed through the logistics chain. The relevant GST information refers to the GST registration number of the OVR vendor and the amount of GST paid or an indication to show whether GST has been charged for each item of goods. Logistics service providers would then be required to provide the information to Singapore Customs in a timely manner so that import GST will not be imposed on goods where GST was already collected by OVR vendors. It is important to note that if the relevant information is not presented upon importation and double taxation do occur, the customer can seek a reimbursement of GST from the OVR vendor, and the OVR vendor must provide a refund to the customer if the customer produces evidence to substantiate that import GST was paid to Singapore Customs. If the OVR vendor has already filed and paid the GST collected in their GST return, it may proceed to seek a refund by filing it in the next GST return and maintain evidence that GST charged at the point of sale has been refunded to the customer. Next, We will be explaining the exceptions that are available for LVG. Firstly, OVR vendors can apply for the exception to use import value of the goods instead of the sales value. As explained previously, sales value of the goods is used to determine if the goods fall within the entry value threshold of $400. However, if the OVR vendors are able to determine the value of the transportation and insurance fees at the point of sale, may prefer to use the import value of the goods instead of sales value to determine the entry value threshold of the goods. Import value is determined in accordance to Section 18 of the GST Act and generally comprises the cost, insurance, and freight value, any customs duty payable, commission, and other incidental. OVR vendors can make the election to use the import value by completing and submitting the LVG entry value threshold election form. Once submitted, they may proceed to use the import value instead of sales value to determine the entry value threshold of the goods. The second exception is the exception to apply entry value threshold on a per consignment basis instead of being applied individually to each item of goods supplied. As explained previously, entry value threshold would apply individually to each item of goods supplied, regardless of the way the goods are bundled for shipment. As an exception, OVR vendors may make an election to apply the entry value threshold on a per consignment basis, as opposed to an individual goods supplied, if the following four conditions are fulfilled. The first condition is the OVR vendor has full oversight of the supply and logistics chain. An OVR vendor is regarded as having full oversight of the supply and logistics chain if he is either also the transporter of the LVG or he appoints the transporter of the LVG with the understanding that the consignment will not be repackaged during the transit to the customer. Number two, the OVR vendor has put in place a business procedure or process that enables it to determine at the point of sale if the goods ordered by the customer would be shipped and delivered as a single consignment. Number three, the business procedure or process in point 2 is documented and agreed upon with the underlying suppliers in the case of electronic marketplaces. And number four, the OVR vendor is able to make the necessary GST adjustments should there be subsequent changes to the customer's orders. For example, the change in price, quantity, or weight of the goods ordered that will affect the value of the consignment. OVR vendors can make the election to use the entry value threshold per consignment basis by completing and submitting the form LVG entry value threshold election form. Once submitted and able to ensure that all the conditions are fulfilled, they may proceed to use the entry value threshold per consignment basis to determine the entry value threshold of the goods. Lastly, OVR vendors can apply for the exception to charge GST on LVG imported via sea or land. Under the Overseas Vendor Registration regime for LVG, GST is only applicable if the LVG is imported into Singapore via air or post. However, there may be circumstances where, at the point of sale, the OVR vendor is not able to determine the mode of shipment of the goods. For example, whether the goods will be shipped via air, post, sea, or land. OVR vendors with genuine difficulties in determining the mode of shipment of the LVG at the point of sale may seek the controller's approval by completing and submitting the application to charge GST on LVG imported via sea or land form to charge GST on LVG imported via sea and land. Similarly, to address instances of double taxation, the approved OVR vendors are also required to provide relevant GST information down to the logistics chain for the imports via sea and land. Logistics provider would also need to provide the information to Singapore Customs in a timely manner so that import GST will not be imposed on goods where GST was already collected by the OVR vendors. Moving on, we will now explain the time of supply rules. For the time of supply rules, once the OVR vendors are GST registered, they will need to apply the time of supply rules on each transaction to determine when the supply is made, as they are required to report the supply and account for GST in their GST returns based on the time of supply. The time of supply is triggered by the earlier of when payment is received, or when an invoice or any equivalent document that serves as a bill of payment is issued. Example 8 illustrates the time of supply rules. In this example, the invoice is issued on 22nd March and the payment is received on 23rd March, one day later. Based on the time of supply rules, the time of supply is triggered at the invoice issuance date on 22nd March, as the invoice is issued earlier than the date of payment. If your prescribed accounting period is January to March, April to June, July to September, and October to December, you shall account for GST on the LVG or remote services supplied in the prescribed accounting periods ended 31st March 2023. Next, transitional rules will apply to transactions that straddle the implementation date of 1st January 2023. A supply of LVG will be treated as straddling the implementation date and subject to transitional rules when it meets the following two conditions. Firstly, the supplier's invoice is issued on or after 16 February 2021, but before 1st January 2023. And secondly, the goods are removed or made available to the customer and payment is received on or after 1st January 2023. Such a supply is subject to GST to the extent of the lower of the value of payment received or the value of goods removed or made available to customer on or after 1st January 2023. We will illustrate this with an example. In example 9, the invoice is issued after 16 February 2021 but before 1st January 2023. In this case, this invoice is issued on 30th December 2022. And the goods are removed or made available to the customer and payment is received after 1st January 2023. In this case, the receipt of payment is on 2nd January 2023 and the LVG is removed and made available to customers on 4th January 2023. As this supply meets the two conditions for the supply to be treated as straddling the implementation date, this supply will be subject to the transitional rules. GST will be applicable on the remaining payment received of $100 on 2nd January, as the value of the remaining payment is lower than that of the value of the LVG that is removed or made available to the customer on 4th January 2023. The transitional rules will also apply to non-digital services. A supply of non-digital services can be classified as a discrete supply or a continuous supply. Discrete supplies refer to individually separate and distinct supplies such as online examination services and legal advisory services. Continuous supplies refer to supplies that are progressively and continuously performed over a period of time, such as wealth management services and subscription to memberships in professional associations. A discrete supply of non-digital services will be treated as straddling the implementation date and subject to the transitional rules when it meets the following two conditions. Number 1, the supplier's invoice is issued on or after 16 February 2021, but before 1st January 2023. And number 2, the performance of service and payment received occurs on or after 1st January 2023. Such a supply is subject to GST to the extent of the lower of the value of payment received or the value of the services performed on or after 1st January 2023. In example 10, the invoice is issued on 30th December 2022 with 50% of the services being performed during the date. The payment of $200 is received on 2nd January 2023 and the remaining services are performed on 4th January 2023. As this discrete supply meets the two conditions, it will be treated as straddling the implementation date and subject to the transitional rules. GST will be applicable on the remaining portion of the services performed after 1st January 2023 amounting to $100, as the value of the remaining services performed is lower than that of the value of the payment received on or after 1st January 2023. A continuous supply of non-digital service will be treated as straddling the implementation date and subject to the transitional rules when it meets the following three conditions. Number 1, the supplier's invoice is issued or payment is received before 1st January 2023. Number 2, the services or part of the services are performed on or after 1st January 2023. And lastly, the services are performed pursuant to an agreement made on or after 16 February 2021, but before 1st January 2023. The portion of the service performed from 1st January 2023 will be subject to GST. In example 11, Company A established in Switzerland provides wealth management services to clients worldwide. It contracts with a non-GST registered customer in Singapore on 1st November 2022 to provide wealth management services for the period covering 1st November 2022 to 31st October 2023. Company A invoices its customer on a quarterly basis and issue an invoice on 1st November 2022 for its services for the period of 1st November 2022 to 31st January 2023. As the supply is a continuous supply of non-digital services which straddles the implementation date of 1st January 2023, Company A is required to account for GST on the payment received before 1st January 2023 that is attributable to the portion of services performed from 1st January 2023 to 31st January 2023. Lastly, we will be explaining how OVR vendors can prepare themselves for the OVR regime. OVR vendors should check whether they are liable to register under Singapore's extended OVR regime. For overseas OVR vendors, you should check if you will have a global turnover exceeding $1 million and make significant B2C supplies exceeding $100,000 of LVG and remote services to Singapore, based on your past sales and future business plans. For local OVR vendors, you should check if you will be making taxable supplies exceeding $1 million, including B2C supplies of LVG and remote services to Singapore, based on your past sales and future business plans as well. If liable, you should proceed to register for GST accordingly. OVR vendors should also start allocating sufficient resources to system and process changes to comply with the regime's requirements. You should ensure that your system can identify whether your customer belongs in Singapore for supply of remote services, and allow GST registered customers to provide their GST registration number during the checkout process. You should also ensure that your system can identify whether the goods are LVG at the point of sale, and whether your system can compute the correct amount of GST to bill to the customer at the billing stage. In addition, OVR vendors should work with their logistics provider to ensure that the relevant GST information is passed down accurately to prevent double taxation for the supply of LVG. Lastly, OVR vendors should determine if there is a need to apply for the exceptions that are available, and to submit the request accordingly. OVR vendors are encouraged to apply for approval early so that there is sufficient time to process the applications. For more information on the OVR regime for LVG and remote services, you may refer to our web pages and the e-tax guides on our website. For your convenience, we have included the links in the video description below. If you need further clarification or have further inquiries, you may write in to us at gst@iras.gov.sg. With that, we have come to the end of the seminar on Singapore's extended OVR regime. We hope that through this seminar, we have helped you to understand the rules and mechanics of the extended OVR regime and how to get ready for it. Thank you for your time.